Hello and welcome to Between the Rows. The podcast of Glacier FarmMedia. I'm Manitoba Co-operator Editor Gord Gilmour. We've been through a decades-long period of low interest rates, and now they're headed up. A generation of Canadians, including Canadian farmers, have no frame of reference for this. On this episode, we'll talk to three agricultural economists about where rates have been.
We've had a period of very low and very stable interest rates.
Where they could be headed.
This is the beginning of the end when it comes to front-loading the interest rate increases.
And what that might mean.
The low rates have certainly been capitalized into farmland values. And so as they are changing now, you'd expect the market to adjust.
But first, a message from our sponsor.
Save money, make money with AGI Nico dryers. AGI Nico mixed flow screenless dryers provide 1 to 2 pounds heavier test weight per bushel and require less maintenance than screen dryers. Stainless steel fuel trains mean no rust or corrosion to worry about. AGI Nico Dryer Manager puts remote management and monitoring in your hands. And with 30% in fuel savings, you'll save on every load. That's money in your pocket. Visit aggrowth.com/Nico for more info. That's aggrowth.com/Nico.
And we're back. This is Between the Rows. I'm your host this week, Manitoba Co-operator Editor Gord Gilmour. Alphonse Weersink started his career in the trenches of agriculture lending during the 1980s farm crisis. That left such an impression he later wrote his doctoral thesis on that painful period. He joins us today from the University of Guelph, where he's now a professor, to talk about rising rates and Canadian farmers. Alphonse, thanks for joining us today.
You're welcome.
So we've had a long period of low rates, and it's making these new rates that we're seeing seem high. But are they? What's the context of them? Like, I think back to some of the loans I took, and I took out loans at far higher interest rates than these.
Yes, I think context is important because if we look at, we've had a period of very low and very stable interest rates, and over the last year, essentially 5-year mortgage rates have doubled from like low 3s to close to 6. But we talked earlier about loans that you took out, loans that I took out. I was involved in the farm financial crisis, and I remember 5-year mortgage rates at 22%. So we're nowhere near that. But if you're looking at what's happened over the last year, it's been a pretty dramatic increase.
Have we hit a point at which farms are going to really start to feel the pinch? Is there a pain point, or is it sort of more of an individual farm's individual circumstances sort of a situation?
I think it very much depends on the individual farm and which sector that they are in. If they are heavily indebted and the debt is associated with assets that are not increasing in value, and in a sector where their prices are falling, they're going to be really in a tough bind. But I think as a whole, I think the sector is going to be okay. I think everybody's going to be affected negatively by rising interest rates. I mean, their costs are going to go up, but is it going to be a real crisis? I don't think so. At least the signs don't point to that right now.
Should we be a little concerned about the level of farm debt? I know that over the last few years, I've seen a lot of press releases, one after the other, about new levels of farm debt. I've always been told it's okay because those are productive debts. But should we be a bit worried about the debt level headed into this period of rising rates?
Again, I think it's tied with the individuals and their earning capacity. For the longest time, we've heard that, debt levels are going up. I think one of the changes now compared to particularly in that 1980 period where we had this farm financial crisis is that equity values have really risen in agriculture. Asset values have risen at a rate higher than debt levels, and so the net worth of farms is significantly better than it was in that time period when there was a financial crisis within the sector. So it's been going up, but I think generally we're pretty solid foundation. Not only have asset values gone up, but there does not appear to be troubling signs for commodity prices, at least in the near future.
And I guess there's some hope here that the Bank of Canada seems to have eased up a bit on the accelerator pedal. Should we take this as a sign that we won't see huge increases going forward, that we're kind of stabilizing a little bit, or is it a little early to dust the crystal ball off?
I think it really depends on what happens to the inflation rate. The rate is determined largely by the reason that the rate is going up is to try to this balance between putting the damper on the economy so that prices will fall, yet allowing it still to hum along. And if inflation continues to be higher than its target levels, then we could see, further increases. I think Bank of Canada is holding this, trying to manage the economy in a very tricky way, trying to determine what's the right extent of an increase.
You've mentioned the farm financial crisis of the 80s a few times here, and that's really the ghost in the room that nobody really wants to see a repeat of. And I guess the question I would have then is, do we have any or all of the ingredients for something like that to happen today? Or are there sort of things that suggest to you that we won't see that recreate?
Yeah, it's a very good question, Gord. Again, I was in the midst of it. I was in ag lending at that time. And so it was like in the 84, 85 period. And looking back, the 1970s had some very real similarities to the past 10 years that we've seen. Early 73 is when we saw a boom in commodity prices, prices that in real terms we never saw, and only recently have we seen anywhere close to it. And the response then was to plant fence row to fence row, and farmers, after having difficulty getting credit for the longest period time, were able to get money. Was easy, and it was based on asset values. Asset values rose, prices were great, and but if you start planting a lot, and Russia then was no longer, it came out of nowhere to buy grain, which has kind of led to the price increase. Commodity prices started to fall. We saw more variability, and then inflation became an issue. And it was in the early 80s when the U.S. Fed all of a sudden, out of nowhere, doubled its prime rate. And that shocked the markets. It shocked everybody, and interest rates then climbed for a period of time into the early 80s. And so commodity prices fell. Farmers were heavily indebted and in a much lower equity position than they are now, and so. Revenues down, expenses up. Some were really caught in a bind. I think one of the things that is different now is that the net worth situation is significantly better. I think overall the sector is much stronger financially. Interest rates could climb dramatically like that, but they're still nowhere near where they were at that 1980 period. And the outlook for commodities is relatively strong. I mean, my basis is corn, and for you it's probably wheat. But we were looking at low $2 wheat. I mean, low $2 bushel corn in that period, and and we're in another realm right now. So I think everybody's going to get hurt by rising interest rates. Is it going to be a real killer for the sector? I don't think we're at a point to say that's going to happen.
And what, if anything, then can farmers do to protect themselves and position themselves to weather this coming storm?
Yeah, I think looking at any risk management tools that are available to them, including business risk management programs from government, locking in prices, locking in their crop prices when they know that they can guarantee a profit, a positive net return on those, perhaps locking in long-term debt. And I think, those are sort of the risk management tools. One thing that also a change from that 70s, 80s period is the increased use of outside equity into the sector. At that time, farmers felt like they had to own all the assets that they operated, and that's no longer the case. I mean, just think that there's, 40% of the cropland is rented in Ontario, or at least I think in Canada now, and so the use of outside equity, not feeling like they have to own every piece of asset that they operate, is an issue, or is no longer an issue, and that exposes you to more financial risk.
That comes to the end of my questions, but I always give the opportunity to the experts when I'm talking to them. Anything else you would add to this conversation that you think it's important for farmers in Canada to know?
Yeah, I don't know. It's, this gazing into a crystal ball about what might be going to happen to interest rates. I think everybody is quite concerned. I think more so in, the general consumer sector. There's a lot of people who are house poor, okay, have borrowed heavily, and this is a non-income earning asset, and as opposed to agriculture, they've invested in assets that generate returns for them, and those assets have actually gone up in value and look like they should continue generating returns. If I look back at my time in the farmers who really struggled in those early 80s, they had what we referred to as an iron problem. They bought equipment much bigger in size than what was necessary for and didn't necessarily generate the income. So if you in contrast, investing in land or other assets that generate revenue for the business. So that's in contrast for the farm sector, doesn't have that same sort of worry as a general housing sector, I think. And I think that's, you'll hear the discussion for the average consumer versus the average farmer, and the average farmer is fortunate that their revenues are likely to go in the near future anyhow, look positive.
Well, thank you very much for joining us today and explaining some of this to us.
You're welcome.
That was Alphonse Weersink of the University of Guelph. You're listening to Between the Rows, the podcast of Glacier FarmMedia. JP Gervais is Vice President and Chief Economist of Farm Credit Canada, the country's largest agriculture lender. He's obviously been watching the interest rates with a keen eye. He says there's no doubt it's been a steep trajectory, but he joins us today with a message of hope. JP, thanks for joining us today.
Well, always a pleasure, Gord. Thanks for inviting me.
So at the most recent Bank of Canada rate increase, it was a bit smaller. We've seen full point increases. This one was half a point. Is there anything much that we can divine from this change?
Well, I do think that this is the beginning of the end when it comes to front loading the interest rate increases needed to bring down inflation, right? So if you recall, I think the first supersized increase in the overnight rate at the Bank of Canada that we got was in July. And at the time, it was a big emphasis of the bank was that we need to front load the interest rate increases that we feel are needed to bring down inflation. So we need to be a bit more aggressive. And they proceeded to lift the overnight rate by a full percent. And that was a big shift for sure. And then we saw interest rate increases of the banks starting to come down a little bit, right? So we had a 75 basis point increase. And then now, just recently, we had a 50 basis point increase. And I do think that we're starting to see a plateau or the beginning of a plateau when it comes to the overnight rate of the Bank of Canada. I believe that the question now going forward is, first of all, let's keep monitoring first that indeed it does bring down inflation, because, inflation overall, it's starting to come down, but it's mostly because of gasoline prices, right? So gasoline prices did come down and that brought overall inflation down. But if you exclude gasoline from the overall measure of inflation, we have that most prices that are included in the consumer price index actually show quite a bit of inflation still. So we kind of stabilized inflation with the interest rate increases so far, but it takes time for those rate increases to work their way through the economy. So I do expect that at some point, in the next couple of months here, we're going to see inflation overall, not just for gasoline prices, but overall coming down. And that would mean that we're now going to see the Bank of Canada rate sort of plateau. But I do expect that we're going to be at that level for a little while here. And I think this is the interesting question for operations that are thinking about, that have their decisions in front of them to whether or not they should be renewing their loans at what rate and for how long. I do think that I think despite perhaps a future economic slowdown in the economy, that we're going to see the Bank of Canada rate stay at that level for a little while in 2023.
And how much autonomy does the Bank of Canada really have to set rates? And I think in a lot of cases we really mirror what the U.S. is doing to protect the loonie and the value of the loonie. So how much wiggle room does the Bank of Canada really have here?
Oh, well, not so much, that's for sure. But I actually look at the issue a little bit in a different way, right? So yes, indeed, interest rates between, like if you look at the interest rate of the Bank of Canada versus the interest rate of the Federal Reserve in the US, of course, they do matter when it comes to the value of the Canadian dollar. And if we start increasing the overnight rate faster than the US, then this is going to bring up the value of the Canadian dollar. And on the flip side, if the U.S. is a bit more aggressive in lifting its overnight rate or its discount rate, then we're going to be seeing a depreciation of the value of the loonie. And so, but the way that I think about it is that the value of the exchange or the exchange rate or the value of the loonie does have an impact on overall inflation, which itself drives the Bank of Canada decisions, right? So it's not just that the bank is basing their decision on the value of the loonie. It is that the value of the loonie has an influence on inflation. And so it does have an impact on the Bank of Canada decision when it comes to interest rates. So if we have a lower Canadian dollar, and in the last little while here, the Canadian dollar has lost value against the US dollar. A couple of reasons why: maybe a little bit of a decline in oil prices because of fears of a global economic slowdown and so forth. But, the fact that we lost value against the US dollar has actually lifted inflation, which forces the bank or leads the bank to react and raise interest rates if it wasn't the case that the loonie would fluctuate based on what's going on in the economy. So I do think that it's in reaction of. I don't think it drives the value of the loonie, drives some of the decisions of the Bank of Canada, but it of course, at the end of the day, however you look at the issue, we are, in a way, going to mirror to some extent what will happen when it comes to interest rates in the U.S.
And then boiling things a little bit further down to the agriculture sector in particular, is the agriculture sector somewhat insulated from this because they're enjoying relatively higher prices for their commodities?
Well, yes, absolutely. I do think that, one of the good things that we have going for the ag sector is the strength in commodity prices. And really, if you look at different scenarios, if you look at some of the drivers in commodity markets, whether you look at the war in Ukraine, whether you look at some of the weather issues and challenges that some parts of the world had to deal with in 2022, the fact that we had a good crop, In other parts of the world, let's say Europe, that was not as good for sure. They had to deal with some significant weather challenges. There's a little bit of a few question marks around the size of the crop in Russia and so forth. But all of that, I do think, point to some of the fundamentals in the market that point to a strong market for ag commodity prices. Now, there is, I think, one downside risk, and that risk is that we have in 2023 a global economic slowdown that would be significant enough that it could, and I'm saying it could, lead to a decline in the demand for ag commodities, right? So there are some countries that are importing quite a bit of ag commodities, but those countries are also a bit more sensitive to economic conditions. In other words, when income comes down in these countries and these food importing countries, then that leads to a decline in demand, and that would lead perhaps to lower prices. So I think that's the one downside risk that we have to monitor in 2023. If there is a mild economic slowdown globally, and really, I don't think the question is whether or not we'll be in a recession. And I think it's an interesting question in and of itself, but I think only folks like myself should be worried about that. I think the main focus should be about, is the world economy leading to still very sustained strength in the demand for ag commodities? And if so, I do think that we'll be okay in a sense of having fairly robust commodity prices for the next marketing year. So in some sense, yes. I mean, the high commodity prices are shielding a little bit the ag sector from some of those inflationary pressures. But we were just talking about interest rates, but overall inflation also impacts the overall costs on the farm. And so costs have been going up, as much as 45% if you look at the last couple of years on a standard, wheat canola rotation in the prairies. But that 45% increase in costs has been offset by strength in commodity prices as well, right? So bottom line is, I do think that we're looking at positive margins for the 22-23 marketing year. But as I said, let's keep an eye on some of the downside risks and make sure that we have a good risk management plan in place to absorb and face some of the volatility going forward in the marketplace.
And that actually leads to my final question. That is, what would you tell farmers as they're looking to manage this kind of risk, this interest rate risk? It's an era of rising rates, especially some of the younger producers may not have seen this. How much danger is there really out, and how much risk is there to manage? And what would you tell farmers who are looking to manage that risk?
Yeah, it's all a matter of perspective, isn't it? I ended my answer to your previous question talking about a risk management plan. I think it's a bit of a cliche, but I think focusing on your risk management, whether from a financial standpoint, marketing standpoint, and so forth, I do think is critical at a time when, yes, we are faced with really high volatility as well as rising interest rates. So make sure first and foremost that you understand how much exposure you have to increase or higher interest rates. So if you have to renew a loan and you have to face an increase in the interest rate of 2, 3, or 3.5%, how much is that or how much exposure and risk does it create financially on your farm and your operation, and what are the plans to mitigate that risk and mitigate the increase in interest rates? So to understand, the various implications of higher interest rates, perhaps continued higher cost of production on the farm, as well as perhaps some decline in commodity prices, as we alluded to. I don't expect it to be the case, but there's always a risk for sure. So the first and foremost, I do think, is to have a strong risk management plan when it comes to your financials and your marketing strategies, to understand what kind of exposure you have. And then based on that understanding of the exposure, then you can make decisions about whether or not you should take risk off the table, right? So perhaps, it's not super enticing right now to lock in interest rates at a much higher rate than what rates were about as little as a year ago, maybe. But at the end of the day, it might be the more prudent thing to do, given that, the exposure you have and the risk exposure you have to perhaps additional increases in interest rates. as we discussed at the very beginning of this interview, I mean, I don't expect borrowing costs to climb significantly from the current level, but there is always a risk that inflation is not necessarily fully contained, and then we do have that additional rate increases are required. So for me, it all starts with the risk management plan, and then surround yourself with people that can help your operation move forward under the current volatility. I often say, hey, have a mindset of a CEO. And what I mean by this is that a CEO of any big business is not necessarily the expert in everything, right? So a CEO, take any large successful company, the CEO is not the expert in human resources and not the expert in marketing, not the expert on finance. But what the CEO does is surround himself or herself with folks, resources that can help the business grow, and the CEO can then focus on the strategy. And I do think that's one of the mindset that we need to adopt a little bit more in the ag sector. Let's focus on the strategy in the business. Let's spend time working through, some of the strategies. Where do you want to take your business in the next year, 5 years from now, and surround yourself with some of the resources that can help you get there. So I think that would be the two things, first and foremost, that need to be taken into account going forward in this pretty volatile environment, I would say.
Well, thanks, JP. I appreciate you taking the time today.
Always a pleasure, Gord. Thanks for the invite.
That was JP Gervais of Farm Credit Canada with some insight into how farms can manage rising interest rates. A farmer's greatest financial asset is their land. Rising interest rates can affect land values. Will it be up, down, or sideways? Chad Lawley, an agriculture economics professor at the University of Manitoba, joins us now to explore that question. Chad, thanks for joining us today.
Yes, thank you for having me.
So land prices and interest rates, they have a relationship, but I have to be honest, I'm not sure I understand it very well. Can you tell us what it is and how closely the two are correlated?
Rates of borrowing are important determinants of demand for farmland. And so when rates are low, demand is going to be higher. Borrowers are going to have an easier time financing. When rates increase, we'd expect demand to fall, and so land prices should fall as well. So there's a high interest rates, lower land values, lower interest rates, higher land values, so a negative relationship. Interest rates are also helping to determine opportunity costs for say other investments, and so when outside opportunities are better, so rates are higher, it can suppress demand for assets like farmland.
It's not like the rates go up 1% and demand goes down 1%. It takes a little time for it to work through. And
yeah, that's right. And it's going to depend, in part on sort of expectations about where rates are going. And so we've really had a long period, over the last 3 decades, where real interest rates, so that nominal interest rate we see adjusted for inflation, where that's been falling for some time. That's also been a period of increasing farmland values, but I suspect that, as you say, that relationship is not one for one, and increasing prices is probably reflecting just the strength of the farm economy in general.
You allude to that long period, and it has been a long period. I was thinking about this the other day. I remember my first mortgage in 2002 was at just over 5%, and I thought that was a marvelous low rate. I'd taken a student loan out a few years earlier at 13%. So my lawyer actually was doing the paperwork darn near high-fived me. He thought I got such a great rate. And now we're just over that, and everyone's getting a little bit concerned. So I guess my question is, for that long period of low rates that people have kind of gotten used to it, has that had a distorting effect on the value of assets like farmland?
Yeah, I don't know if I'd say it's had a distorting effect, but the low rates have certainly been capitalized into farmland values. And so as they are changing now, you'd expect the market to adjust somewhat. That correlation between interest rates and land prices is really hard to determine, because it's this sort of widespread macro variable, and lots of other things are changing at the same time. So, as an example, right now we've got really high inflation, and inflation will tend to increase land prices. So, it's, we might not observe a really direct relationship between these interest rates and land prices going forward.
Yeah. That's a great point, actually. The other one that leaps to mind for me is the commodity prices. They're generally on the stronger side right now, so that would have I would expect a somewhat insulating effect on the concept land values would fall.
Yeah, for sure. Yeah, and and farmland, I think, is viewed as by investors as a good inflation hedge, and it's partly because in times of high inflation we also have high commodity prices, and you need land to get access to those prices. And so, yeah, both of those are going to insulate to some extent against these increases in interest rates.
How do you feel like the scenes are going to change then as rates have risen? What will the implications be for farmers?
Yeah, so I think that will soften demand for farmland. I'm not, I guess you hate to say farmland prices are not going to decrease right before they do, but, I wouldn't suspect that these higher rates are going to have an immediate effect on farmland values. And it's, it's because commodity prices are still high, and inflation is still high. And so farmland, I think, will continue to be attractive for investors and likely for farmers.
So would it be fair to say that you might be surprised if we see farmland values fall in the future, but you wouldn't be surprised if we saw them sort of stay on a more even keel and we'll back away from some of the big increases we've seen?
Yeah, I think that's fair to say. Yeah. Yeah. So far we've seen, if you look at net income figures from Statistics Canada and sort of plot them out with farmland values, I think over the last, 10, 15, 20 years, there's been a pretty tight correlation between net income and farmland values. So it seems, at least in Saskatchewan, Manitoba, so it seems that they're tracking those fundamentals pretty closely right now. So I'd expect that to continue.
And one final question, and I'm sorry, I didn't really sort of prepare you for this one, but I am curious about it. Is there a difference in the type of debt here that we're seeing in the agriculture sector versus, say, in the wider consumer economy? A house is not a productive asset, although we all like them to live in. A piece of farmland is. Does that make it fundamentally a different sort of a play?
Yeah, I certainly think so. So potential homeowners are looking at possibility of a recession coming up, and so those higher borrowing costs would have very real impacts on sort of decisions they're making about home ownership. Farmland is different, I think, because it is a productive asset, and we've got high commodity prices right now. Those can come down, but right now they're high, and again, inflationary times tend to be good for farmland prices for that reason.
Well, thanks for taking the time to explain this to us.
Yeah, thank you for having me.
And that's your roundup of all things interest rates from Between the Rows. I'm your host, Gord Gilmour, saying so long, and we hope you'll join us again next week.
Save money, make money with AGI Nico dryers. AGI Nico mixed flow screenless dryers provide 1 to 2 pounds heavier test weight per bushel and require less maintenance than screen dryers. Stainless steel fuel trains mean no rust or corrosion to worry about. AGI Nico Dryer Manager puts remote management and monitoring in your hands. And with 30% in fuel savings, you'll save on every load. That's money in your pocket. Visit aggrowth.com/Nico for more info. That's aggrowth.com/Nico.